Good afternoon, everyone. My name is Joe Bacella, Director of Client Success here at Chaikin Analytics. We'll be starting our webinar in just a few moments. If you have any questions regarding today's presentation, go ahead and utilize our GoToWebinar chat window. Any kind of questions that you're able to go ahead and chat through, we'll be sure to address during our Q&A session. Again, we'll get started in about 1 minute. All right, again, good afternoon, everyone. My name is Joe Bacella, Director of Client Success here at Chaikin Analytics, and I'd like to welcome you to Looking Ahead to 2016, Anticipating and Preparing for Next Year's Market. Presenting today is Marc Chaikin, founder and CEO of Chaikin Analytics, and John Schlitz, Chief Market Strategist of Chaikin Analytics. This webinar, again, is being recorded, and it will be sent to all of those who have registered for today's session. Again, please submit your questions via the GoToWebinar chat window. Now, Marc Chaikin's key contribution to the financial world is the Chaikin Power Gauge Rating, a proven 20-factor model that uniquely combines fundamental and technical factors. An accomplished analyst himself, John Schlitz has more than 30 years on Wall Street serving institutional investors and traders. As Chief Market Strategist for Chaikin, John blends his own analysis with that of the Chaikin Power Gauge Rating and other Chaikin proprietary analytics to help Chaikin subscribers make more profitable trades and investments. Now, to get us started, here's Marc Chaikin.
Thank you, Joe. Joe, can we do a sound check with the folks? Because I didn't hear that lady say the webinar is now beginning, so I don't know if you actually started the webinar.
Yeah, absolutely. If you are able to hear our audio right now, go ahead and chat in real quick, just to make sure our audio and our video is working. Bear with me for a moment here. Let's see what kind of responses we're getting.
Yeah. Yes. Okay, we're good.
Excellent.
Terrific. Well, thank you, Joe, and welcome, everybody. John Schlitz and I felt it was really important as we head into 2016 to give you a solid overview of what to expect. And we're also going to look back at 2015 and see what themes influenced the market and how Chaikin could have helped you identify those. Well, you all know me. Market technician, quantitative analyst, and entrepreneur. Came out of retirement to start Chaikin Analytics. But I'd like to introduce my long-standing colleague, John Schlitz, who is one of the most brilliant market strategists, market technicians I've ever met. And his work in our morning market insights is quite extraordinary. If you're a shorter-term trader, preps you for the market. So, John, why don't you introduce yourself to the folks?
Hello, everyone. As Marc mentioned, I'm a technical analyst by trade, and I worked with, just to give you a brief history, I worked at Lehman Brothers for 15 years on the institutional trading desk, serving both the institutional clients and all of the traders, obviously. And then I moved over to Instinet, where Marc invited me to join him after he sold his first company to Instinet. And I was there 17 years until a few years ago when I semi-retired, and then Marc called on me to help him with his new effort, Chaikin, and I used it for about 6 months, and I was just very impressed with how it was for me as a technician. It provided the missing element because, you know, as a technician, we only have the charts and indicators to go by, but most technicians on the street also have analysts and strategists and economists, and they leverage off of that research. Well, if you're not lucky enough to have that, then you need something else, and that's where Chaikin Analytics really filled the void for me in terms of organizing all that fundamental information into something easy to use and easy to incorporate with technical. So, I liked it enough that I thought it was important to join the effort and try to help our clients use it more effectively, and hopefully my experience from the institutional side will give it a little different bent and a little extra value than what you may be used to getting from from other internet services. So I'm glad to be here, and I look forward to working with you.
All right, John, thank you, and let's dig in. Chaikin Analytics has really established itself as a brand. I've been on CNBC, I was on Fox Business just yesterday at the closing bell. We've been written up in Barron's. But one thing I want to highlight is that as we move into the new year, you're going to hear a lot of pundits on CNBC and Fox Business telling you what they think the market's going to do in 2016. And I can tell you from having been on these shows that even the smartest of the analysts on TV, and although Jim Cramer is a brash showman, he is pretty darn smart. But not everybody you hear on CNBC is going to steer you in the right direction. And Chaikin Analytics is sort of your independent voice, your ombudsman, if you will. It can help you sift through all the chatter you're going to hear from the talking heads on CNBC. And here's just an example of that to start off the webinar. Jim Cramer had been very high on La Quinta, went public in April of 2014, so we started getting a power gauge rating in April of 2015 because we need a year's worth of data. And along the way, the power gauge rating turned bearish almost immediately, and the stock started underperforming the market, and we had a whole series of sell signals and negative money flow in Chaikin Analytics. And for those of you who aren't familiar with these terms, we're going to cover them in depth in the examples as we move along on the webinar. But in September, Jim Cramer basically threw in the towel. He said, now look, I got La Quinta wrong, mea culpa. I should have been more skeptical and less willing to believe the CEO's exuberant bullishness. And I could have substituted a more Trump-like word for bullishness, but I didn't. But don't you think that if Jim Cramer had been using Chaikin Analytics, he would have been compelled to rethink his position and not gotten sandbagged? And the interesting thing on this chart, by the way, Jim Cramer has been quoting Chaikin Money Flow, which is this red-green indicator here that measures institutional accumulation and distribution. And a couple of minutes into the webinar, John Schlitz is going to share something that he's been teaching the institutional traders and investors that he worked with as a sort of inside tip on how to use Chaikin Money Flow. Very, very valuable, and John has given it a name, and we've seen it work over and over again. But the interesting thing here is that even after Jim Cramer threw in the towel, the CEO had said, you know, we're going to miss our numbers. The stock rallied from 15 all the way to 17 and then gave a sell signal in Chaikin Analytics. And if you had been following the Chaikin methodology and were stuck in La Quinta, you could have sold it at 17 on the way down to 13. So it's never too late to sell a stock, but the real message here is don't blindly listen to what you hear on TV or read in Barron's. Check it out with a disciplined methodology like Chaikin. So in the next 45 minutes, you're going to prepare yourself for 2016. We're going to recap 2015 and see what lessons we've learned and look ahead at what to expect in 2016. And the main focus is going to be twofold: finding the winning stocks for the new year, and as important, avoiding the losers. We have an expression here at Chaikin Analytics: find the winners and drop the losers. And if you can drop one or two losers every year, you're positioning yourself for success. So I thought we'd start out with a 5-year view. I've put all the relevant labels on here, but the bottom line is that we made a W-shaped bottom in 2011, and up until August of 2015, it was a pretty easy market. Now, I don't ever like to call the market easy. I believe what Warren Buffett's partner Charlie Munger said was, anybody who thinks the market is easy is an idiot. But buying dips worked. And when you bought the dips, you got what are called V-shaped bottoms. So the market bottoms in two ways: in the form of the letter W, where you make a low, rally up, then make a lower low or test the previous low, but usually on much less volume because the panic phase is the first phase, as we saw in August. And for 4 years, we didn't have to make W bottoms because all the corrections were between 5 and 10%. These were what were known as V-shaped bottoms. And then suddenly in August of 2015, the bottom fell out of the market. And we're going to zero in on a 1-year chart where John Schlitz is going to talk about Chaikin money flow and how it tipped you off. But basically, we made that bottom in August of 24th, 5th of 2015. It was pretty much a panic low with the futures down 1,000 points into that Monday. And by the way, that's why you need to read John Schlitz's Morning Insights, because John tells you what's happening in the pre-market, so you're not blindly putting in market orders on ETFs and regretting the fact that you fell in line with the panic selling. But we've rallied up. We failed to make a new high, and we've had a series of lower highs and lower lows. So the next chart shows that. And John, why don't you speak to some of the key points here relative to money flow and the price patterns that you're seeing on the 1-year chart of the spider, which represents the S&P 500 index. And I've put the power bar up because I know you're putting a lot of analysis into the power bars for the various indexes.
Well, sure. I guess the most conspicuous thing I see is that during the sideways movement for most of the first half of the year, outside of the very beginning of the year, money flowing into and out of the spiders was basically neutral, all right? And what we don't want to see when we're trying to break out to new highs is, upside pushes and no better than neutral money flow. And that started to change towards mid-year when we went up and almost tested the upper band, but ended up checking up at the long-term moving average. And you can see where Mark has the cursor that money flow stayed definitively negative in that effort. And that was a warning sign that institutional sentiment was changing. Now, it did improve slightly in the subsequent consolidation after that dip off the high, but the truth is we look at money flow not only over a 1 or 2 week basis, but in terms of persistency. And when we see a sideways pattern aging like that, getting into the 6-month, 5 and 6 months time frame, and we see very anemic and apathetic accumulation, it tells us to be careful. It wasn't a clear-cut negative divergence, it wasn't a major sell signal, but it did tell us back then to be cautious. And Mark put the power bar up because back then we were barely even Steven on the power bar ratio in terms of bullish stocks to bearish stocks. So it just meant that you needed to be patient and wait for some better internal and indicator situations to occur, and they didn't. And so when they devalued the yuan, the system was vulnerable. It didn't tell us the reaction was going to be that severe, but we already knew to be lean at that point because just nothing was telling us to be otherwise.
So what I'm seeing here in the current environment is somewhat similar to what John was describing in the June-July period. Something that's really interesting is that we were talking about a W bottom in August and September, and that first rally up, which was, for you people who are Fibonacci fans, a 6.18 retracement of the down move with Chaikin money flow staying negative. So you had over a 200-point rally in the S&P 500. You went from 1867 on the S&P 500 cash to over 2,000. So you had better than a 240-point rally, and money flow should have gone positive, and it didn't. And that's what encouraged me to believe that there was a W bottom coming. In this case, the W in the spider came at a higher level. This in the S&P cash index, it actually equaled the previous low. And then when you rallied up, you got that kind of money flow that John likes to see that you had in the early part of 15 rather. You got really positive accumulation and Chaikin money flow. That meant that the institutions were really backing the move. They were jumping on board. But in spite of that, the Chaikin Power Bar, which is a really unique way to look at the internals of the various stocks in the particular index, in this case the 500 stocks in the S&P 500, it never went positive. In this whole rally, the best it could come was even on one day. And it's still negative today. And that's part of the reason, in my opinion, that the market's having trouble getting through the old highs. So we now see deteriorating money flow heading into year end. And we are getting a bounce. We're getting that little bit of a Christmas rally. But as John has pointed out in his morning insights, there's a lot of resistance in the 2060 area all the way up to 2080, 2100 on the S&P 500. So although we're not bearish on the market has to prove itself. And it's done a pretty good job in the last 2.5 days of proving itself. But as John pointed out in his market letter today, the last week of the year is usually filled with applause. A lot of people are on vacation, the volume drops off, and so the expectations for next week are not very high. I do think, though, that now that we're up on the year again, that we probably will finish the year with a gain of about 1 to 2%. But then in the first quarter, as we'll see, the market is once again going to have to prove itself. So the S&P 500, the spiders, represents the large cap universe. Let's look at what the small caps did. Well, the small caps clearly underperform, whereas the S&P 500 got up close to its old high. It got up to 2117. The high had been 2137. The small cap stocks didn't even come close to matching their old high. They missed by about 3 or 4%. And you can see that down here in the relative strength of the IWM, which represents the Russell 2000 index, versus the S&P 500. So what you've gotten in here is a weak rally. Now again, money flow followed the rally, but it's been ebbing since then. Now what's interesting is that the underlying potential for small cap stocks is actually bullish. This Chaikin Power Bar for the IWM shows 463 stocks with bullish ratings, 372 with bearish. But the price action hasn't confirmed that yet. So you need the price action, just as you do in individual stocks. We call that sort of the dynamic duo, Chaikin Power Gauge and Chaikin Money Flow confirming one another, and sometimes it's relative strength and the power gauge confirming each other. You need that confirmation in positive price action before you want to think that small caps are the place to be. So John, you prepared this chart. Why don't you briefly tell people what we're looking at here in terms of growth versus value?
Well, I really just wanted to point out, because a lot of people don't realize it, that there was almost 1,000 basis point differential between growth and value. Although you do have to water that down a bit, because as I put at the bottom there, Netflix, Amazon, and Starbucks accounted for a large portion of that outperformance in growth, and at the same time you had, obviously almost every energy stock leaning heavily on value. So the spread really wasn't as wide as 1,000 basis points if you take those factors into account, but it still, puts into pretty clear perspective that while everyone's talking about a flat market, the market was really anything but flat this year when you start to look at the individual sectors and subsectors and themes.
So growth represents the highest aspirations of Wall Street investors. These are the companies that typically attract a following when the market is strong and when the story is positive, like it is with Netflix and Amazon and Starbucks and Google. Value represents the stocks that are sometimes what's known as defensive stocks, like the beverage stocks and some of the drug stocks. But value also is sometimes a label that's put on fallen angels like the energy stocks, because based on normal analysis, these stocks look cheap to value investors, but sometimes cheap is relative and cheap begets cheaper. So the question is, will value overtake growth in 2016? So what I put up here is a one-year chart of the IWX, which is an ETF based on the Russell 200 top value stocks, large cap value stocks. And we're seeing that the 200 top large cap value stocks, just as with the IWM, have been underperforming the S&P 500, which was the large cap index itself, for 12 months. How do we know that? Because this is our unique relative strength indicator that goes from red to green, and when it's red, it's telling you that that particular ETF, index, or stock is underperforming the market. And we just had a relative strength sell signal here. We had one right before the collapse on August 24th. And how does that sell signal get generated? It's so simple. If a stock or an index or an ETF is underperforming the market and it rallies above its 21-day average and then drops below it, gets overbought in the doing, then we trigger a relative strength sell signal. And these tend to be very powerful in both stocks and indexes. But what's interesting here is that whereas the power bar for the IWM, the small cap stocks, was positive, the power bar for the 200 top value stocks is still negative. 21 positive, 31 negative. So not yet power bar confirmation, not yet confirmation from the relative strength indicator that value is going to overtake growth in 2016, although you're going to hear a lot of that on CNBC. So here's 2015 in review. These are the factors that really drove the market in 2015. One was economic growth. The U.S. economy was a sort of slow, steady Eddie growth economy, 2% a quarter. That was just fine for a whole slew of stocks, particularly domestically oriented stocks. Energy clearly was a negative force in the market. Price of crude oil dropped from over $100 at its peak in 2014 to under $34 just recently. And what's going on in China is a big driver because China has been a driver of growth for international stocks like Caterpillar and Deere and many of the commodity stocks like the steel stocks that have depended on the expansion in the economic sector in China. Volatility was not much of a factor until August, but there's plenty of volatility ahead, in our opinion, in 2016. And part of the reason is Janet Yellen and the Federal Reserve Board. First rate hike in over 10 years. Someone made an interesting point that the last time the Fed raised rates, the iPhone didn't even exist. Think about that. We've been in a ZIRP, zero interest rate policy, for now 6.5 years since the financial crisis. We got our first Fed rate hike. Well, the problem is that now, based on the comments from Janet Yellen and some of the Fed presidents, every Fed meeting, which happens about every 6 weeks, is going to cause market volatility because the Fed has said that every meeting is a blank page, it's a clean slate, and they're going to look at the data leading up to the meeting to decide whether future rate hikes are in order. And that translates to volatility. So you've got to be aware that 2016 is likely to be much more volatile than 2015. Now, looking ahead to 2016, what's likely to move the market? Future interest rate hikes are clearly going to be market movers. Dennis Lockhart, president of the Richmond Fed, said that the likelihood was 4 interest rate hikes. I'm sorry, Jeffrey Lacker, the Richmond Fed. That would really roil the markets. My view, what I said on Fox the other day and on CNBC, 2 interest rate hikes is about all you're going to see, and if that's what happens, the market's going to like it. Commodity prices will once again drive the market because as oil goes lower, the risk of credit defaults in high yield bonds increases, and the potential for a spillover into the bond market, the non-high yield bond market, is a risk that people are concerned about. Price of steel is down, reflecting the weakness in the Chinese manufacturing sector. Next factor that's going to influence the market is the U.S. dollar. Will it be weak or strong? A strong U.S. dollar combined with plummeting oil prices is part of the reason that the market had trouble gaining traction in 2015, because the strong dollar hurt the big multinational companies like Caterpillar and Honeywell, Triple M, and IBM. Election year patterns are also going to make a difference, and we're going to look at all of these in a moment. And identifying strong and weak sectors will help you figure out which way you should move in 2016, because there may be a shift from some of the sectors like healthcare and technology that have been leading the market in 2015 up until that August crash. So let's look at some of these factors. John Schlitz has put together some wonderful charts to show you the impact that the Fed decision to hike rates for the first time has on the stock market. So John, I've put a couple of labels on here to enhance your work, and why don't you tell the folks what they're looking at here on this very, very powerful analysis.
Okay, Mark. Well, in this chart, as the headline sort of gives it away, we have the S&P in yellow and the 10-year yield in white, and we see that even though there's substantial fears out there that the equity market will be pressured by higher rates in 2016, the result of higher rates is actually typically the opposite. The green shaded areas don't follow the Fed increases, but they do mark every substantial increase in the 10-year yield where the S&P also moved higher. And as you can see, many of the advances in the S&P were often quite substantial. They averaged about 30%, with only one under 27% actually. Now, many of those gains obviously happened over multiple years, but it still highlights pretty unequivocally that the market can and usually does advance when rates rise, and that goes for when the long-term trend of rates is rising as well, which we see in the first third of the chart, as well as falling, which has been the case, thereafter. From the 60s to the 80s, we actually had a very substantial interest rate increase, and yet the market, more often than not rallied with those increases. So, shorter term, however, as the next slide shows, the market tends to struggle, and I'm not going to spend a lot of time on the next 3 or 4 slides, but I wanted you to be able to see it visually. In '94, the S&P fell about 7% initially and then stayed flat for most of the year.
But John, I might point out that '94, the economy was weak. We hadn't yet benefited from the congressional tax cuts and the Clinton era internet boom. So that's why I labeled the previous slide in the '94 period a weak economy, and the S&P was down. The difference here is that we're in a strong economy. So as we loop through those slides, here's '99, and what are you seeing there, John? And this is a pretty strong economy.
Yeah, in '99 we had a brief blip up after the initial increase, but then we fell 12% before stabilizing. So, it just shows that eventually eventually the S&P recovers and starts, another uptrend. But initially, the market tends to have a bit of difficulty digesting the concept that not only is, did we have a rate hike, but more importantly that, they're agitating about subsequent rates in terms of frequency and amplitude. And of course, we've been promised over and over again by Ms. Yellen that the amplitude and frequency will be, low amplitude and hardly any frequency, but nevertheless the market's going to agitate about that, especially when it's trading within 2-3% of the all-time highs.
So here we see 2004, pretty much the same pattern, isn't it, John? You get an initial sell-off and then you start moving higher.
Yeah, same thing. We fell about 7%, didn't make any substantial headway for about another 3 months. I mean, personally, because of the anticipation of this month's hike, because it was so feared for so many months, I think it's possible that the choppy action of the market for most of 2015 may have already discounted a fair portion of the volatility that normally follows the initial hike. In other words, we might have already cleared out a fair portion of those sellers that typically surface after the first rate hike back in the fall meltdown, and then again in the subsequent pullbacks in late September and early November, and again earlier this month. So I would just keep that in mind, that that's a possibility.
Yeah, I think that's a good point, because I personally think, and we'll see what the first quarter normally does, that we've got a shot at a pretty good first quarter. But before we do that, let's look at the election year pattern, and this one is pretty definitive, John, so why don't you share that information?
All right. Well, as you probably know, the year before an election is overwhelmingly positive. In fact, there hasn't been a down pre-election year going all the way back to '68, and I believe the streak goes back a lot further than that. I'm not sure if you're familiar, Mark, but that's as far as I looked back. Pre-election years are highlighted by the purple dots. The thick yellow bars in the lower half of the chart show the percentage gain or loss for each particular year. Now, so you can see that the pre-election years have just been, incredibly reliable. And personally, I wouldn't call this year a failure, because we're flat on the year and may finish up. You have to allow for the possibility that the positive influences of the pre-election year really did its job. It's just that it had to counter so many negatives. But in my opinion, it was still there in force.
Yeah, if you avoided energy and materials, your portfolio did pretty well in 2015, and that's where Chaikin comes in. But the bottom line is that 10 of the last 12 presidential election years have been up. So the likelihood is that we'll see further gains in 2016, but the magnitude is usually pretty muted. You get a lot of rhetoric in the election campaigns, and some of it's pretty scary, as we're finding out now, in terms of potential tax hikes and changes in capital gains that one candidate might espouse in the debates. So expect more muted gains, but a lot of volatility in 2016. And here, John, you've analyzed the quarterly action of the market with an emphasis on the first quarter. And what's your conclusion on the first quarter? What does it normally do?
Well, the first quarter is normally reasonably positive. One of the problems coming into 2015 was that the S&P was woefully hyperextended on a quarterly basis. The rally in Q4 of 2014 was the 8th consecutive positive quarter. So this year's Q1 barely logged a gain, and although the Q2 net loss this year was small, the close, as you can see, was down near the bottom of the quarterly range, and the way we measure performance, that's negative. And that made the index vulnerable to violating the 4-year uptrend line that was drawn off the 2011 low, which is exactly what happened in August when China devalued the currency. And while everyone is bummed out about not having a great December, although the last 3 days have obviously been, quite good, we're still up more than 7% for the quarter, which is, I think, a lot more than people were expecting after Q3. And of the last 14 Q1s, only 2 have been down substantially, and that was during the financial crisis.
So summing up, we've got a Fed that is telling us that they're going to go slow on interest rate hikes, but individual Fed presidents sort of speaking their minds, encouraged by Janet Yellen, what I call a Tower of Babel coming out of the Fed. We've got a presidential election year that suggests that the markets should move higher. We've got a first quarter that's normally up, and we've got commodity prices in the US dollar to worry about. And on the next chart, John, you've very aptly analyzed the U.S. dollar after Fed rate hikes?
Well, in terms of the initial reaction to the first rate hike, it's the reaction of the dollar has basically been the same as the market. It's had negative reactions after the last three initial rate hikes, which is sort of interesting, and that's just about every analyst interviewed on CNBC over the past few months has said that one of their biggest concerns is that that the rate increase will push the dollar higher. And as the chart shows, while that is true longer term, the dollar has, definitely struggled after the last three rate hikes in 94, 99, and 04.
And where I think that matters in the first quarter of 2016 is that this next chart that John's drawn up shows you that the dollar is running into resistance. And a weak dollar would actually be a positive for so many of the big multinational companies in the S&P 500 that I believe one of the big bonuses in the first quarter could be a weak dollar, following John's pattern of weakness in the dollar after the first Fed rate hike. So if you add all this up, rate hike normally triggers a little bit of selling. In this case, we got selling in anticipation of the rate hike, as John pointed out. First quarter, we expect to be up. If we get a weak dollar and the price of oil stabilizes, doesn't break $30, but bounces back over 40, we've got, and by the way, the energy stocks led the market higher today as the price of crude oil went up. We've got all the makings, in my view, for a very positive first quarter. But again, remember, volatility is going to rule because every Fed meeting is going to create volatility. So every 6 weeks, you're going to get all this chatter on CNBC about what the Fed's going to do and what it means. And the bottom line is, look at the Chaikin charts on the SPDR, the IWM, the Triple Q, to get a clue as to what the institutions are doing by looking at Chaikin money flow. So how do you prepare for 2016? Well, first of all, you want to use the Chaikin Power Gauge rating to find winners and losers. Really only 3 steps here to preparing for 2016, and finding the winners and dropping the losers. So the Chaikin Power Gauge rating, for those of you who've never been on a webinar with us before, distills 20 factors into this very simple gauge. It's a fundamental view with a high probability of success at telling you whether a stock's going to outperform or underperform the market. It's a very simple display, but it's a powerful indicator. And the reason I say that with a high degree of confidence is that since the Power Gauge rating has been commercially available in January of 2011, when we started releasing research reports on 5,000 stocks, updated nightly based on the Power Gauge rating, there's been a proven record of success. And part of the reason that the Power Gauge model works is that I was mentored in my career by some of the most successful money managers on Wall Street. And as John mentioned, part of what we did at Instinet with what had been called the Bomar Terminal, which was the first Windows-based real-time workstation for portfolio managers and traders, and was basically a technically oriented workstation. Part of what we did was to teach institutional investors and traders how to use our technical indicators, money flow, volatility bands, and relative strength, as part of their daily decision making. Well, in order to do that, we had to learn what their style of investing was, what they looked at, so that we could effectively show them how to use technical analysis. And the 20 factors that you see on the screen now, grouped into 4 components, represent the factors that institutional investors look at every day. And believe me when I tell you that institutional investors are driven by fundamentals. Except for a few wild traders on the floor and some hedge funds who trade strictly on technicals, the real money at Fidelity and T. Rowe Price and Invesco and the big money management firms like Neuberger Berman is driven by fundamental analysis. Some of it's quantitative, some of it's traditional fundamental analysis. But what you see on the screen is what institutional investors look at every day. So just briefly, Warren Buffett would look at the financial metrics. Free cash flow is very important because you can doctor up earnings with accounting tricks, but you can't doctor up free cash flow. Price to sales ratio. Bob Arnott, who runs $180 billion in a quantitative strategy suite, said in an interview 6 months ago with the American Association of Individual Investors that price to sales ratio was his secret sauce for the last 14 years. He has only 4 factors. Independently, I came to that in my 1-year research project to build the Chaikin Power Gauge rating. 85% fundamental. Jim Cramer looks at earnings, loves to have those CEOs on for the high growth company, earnings surprises and disappointments. Technicals are only 15% of the model, but they're all proprietary and they make a difference. And then we look at expert opinions. It's very important to know what the key players on Wall Street are doing and saying about a stock. So we look at analysts, the various Wall Street brokerage firms who are constantly raising or lowering their estimates based on what management's telling them and what they see in the earnings reports. So positive earnings surprises lead to analyst estimate revisions upward. Negative earnings surprises lead to downward revisions, as we saw with La Quinta. And we look at industry group relative strength, which we're going to get to in a minute, and short interest and insider activity. You could do all this if you had unlimited time, but I think all of us know that time is our most precious commodity. And part of what we're all about at Chaikin Analytics is saving you time, cutting through the clutter, cutting through information overload, and freeing you up to enjoy the fruits of your labor if you're a trader or an investor. Take away some of the drudgery of the fundamental analysis. When we first introduced the Power Gauge rating, someone sent us a testimonial saying, it used to take me 2 hours to research a stock, and now you do it in seconds on 5,000 stocks. And that's really what we're all about. But the lifeblood of the success that the Power Gauge rating has had is embodied in this chart. Here we've combined the back-tested results with the real-time results, and the model was frozen in September of 2010. And we released the first product in January of 2011. And the shape of the curve has been the same ever since. The very bullish stocks in the Russell 3000 have averaged a 21% annualized gain, and the very bearish stocks have been flat, and that includes the 6.5-year going on almost 7-year bull market. If we had pulled this chart in March of 2009, the very bearish stocks would have been down 6% over the previous 10 years, and the very bullish stocks would have been up 22%. So even after a 7-year bull market, the very bearish stocks have barely budged. And this is what we are all about, and this is what we want you to come away from the webinar believing in. That there is a methodology based on objective, rules-based criteria that can differentiate between stocks that are likely to outperform or underperform the market. Now, the Chaikin Analytics methodology is encapsulated in this pyramid. At the top of the pyramid, the Power Gauge and industry group rankings, very important. At the bottom of the pyramid, just 2 technical indicators that we're going to show you in depth, Chaikin money flow and relative strength, and then these buy and sell signals, which if you're a shorter term trader or a swing trader or you're into options, can very much improve your timing. Now, a further proof point is a partnership that we launched with NASDAQ in April of 2014. NASDAQ did a very thorough 3-month-long due diligence of the Chaikin Power Gauge rating and came back to us and said, we'd like you to compute and create 3 new indexes, NASDAQ Chaikin Power Indexes, large cap, small cap, and dividend achiever. And in the 18 months that are depicted on this chart, each of those indexes outperformed the underlying NASDAQ benchmark. Now, there was a big if, or what if, in this scenario. What if you couldn't change the portfolio for a year? Now, that's a pretty daunting task because buy and hold is basically dead in volatile markets like we've been experiencing for the last 6 years. But those were the ground rules. Create a portfolio based on the Chaikin Power Gauge methodology that uses the underlying NASDAQ benchmarks and sit on it for 12 months and then rebalance it, which we did on April 1st of 15. So all three of the indexes outperformed their benchmarks. And we had been telling people that the Power Gauge rating had predictive value 3 to 6 months out. This now demonstrates that the Power Gauge rating has predictive value even further out on a buy and hold basis. And just recently on December 7th, First Trust Portfolios launched a unit investment trust called the Chaikin Low Beta Growth Portfolio, where we help them create a 20 stock equally weighted portfolio with lower volatility than the S&P, with the potential to outperform the index. But before we move on to the examples of stocks that we want to show you, I want to take a chart that I pulled from Google Finance that shows the performance of the Chaikin NASDAQ Small Cap Index. These are quotable every day, every second. And remember, we looked at the small cap universe, the IWM, and that's been underperforming the market. And we see that here. This is 1,500 small cap stocks. The IWM is 2,000. And the amazing thing is that since we launched this index in April of 14, the small cap stocks have been down. This is as of noon today, and our small cap index is up over 7%. This is the value of the Power Gauge. It helps you find the winners. Now, I'm going to flip our three-step methodology on its head so that we can do what the pros do, which is what's known as top-down analysis. Whereas we usually start with the Power Gauge to find the winners, that's what's known as bottom-up analysis. But let's see how Chaikin can help you analyze industry group and sector strength and weakness to give you that edge that the institutions have, the good institutional investors, like the Peter Lynch's of the world, because they were able to spot trends in industry groups, bigger trends, macro trends. So the key principle here is that strong groups give you a tailwind. The factors that make an industry group strong tend to persist for extended periods of time. And those are the groups and sectors where you're going to make your biggest gains on the long side. However, if you persist in bottom fishing in weak groups, you're swimming against the tide, you're facing headwinds, and your probability of success drops dramatically. As we saw in that performance chart, the very bearish stocks were flat over a 16-year period, and the very bullish stocks were up 21%. So we're going to show you how to find winning plays on the short side by taking advantage of weak stocks and weak industry groups. So I'm going to let John explain how we look at the 9 sectors within the S&P 500 using our unique power bar analysis.
Okay, well, as Mark mentioned earlier, the power bar simply looks at the components of an individual sector and then ranks them by bullish or bearish. So you can see here that because of all of market volatility that we've seen recently, it's not surprising that the defensive utilities and staples areas have sort of drifted up to the top of the power bar rankings. But what I think we're going to focus on in a little bit is the financial sector is really one that we're looking at pretty closely now, not just because there are more bullish than bearish stocks, but also because obviously, at least conceptually, they tend to do better in a rising rate environment. And even though the interest rate increases are obviously going to be very spread out and very shallow, nevertheless, we've been starting to see some improving money flow and price action in that sector.
John, I threw you a curveball and I actually changed up the sectors we're going to look at. So we are not going to look at the financials, but we are going to look at consumer staples, one of those defensive sectors that John talked about, because when we get to the part of the webinar where you see the stocks that are on John's watch list and my watch list, two of the three stocks that John's watching are in the consumer staples sector. And this is what is referred to as a defensive sector. When you see utilities and consumer staples at the top of the list, it means that the market's nervous. Excuse me, end of a cold. And therefore, utilities and consumer staples have been doing quite well, and you can see that from the relative strength indicator. But consumer discretionary is a place where I think there's a lot of opportunity. I'm not as interested in some of these cyclical consumer staple stocks, but I am interested in some stocks like Activision Blizzard and Nike that are in the consumer discretionary sector, because I think the consumer is going to help drive the stock market and the economy in the first quarter. Wages are up, job growth is up, you still have the effective tax cut from lower gas at the pump, and basically there are some opportunities in consumer discretionary. Part of the reason the price chart is not as strong as it is because of the retail sector. Retail stocks are part of consumer discretionary, and as you can see from the chart, very, very weak. John, I'm going to let you take over for a second.
Okay, Mark. Where did the retail chart go? Okay, there we go. Well, what stands out to me the most here in terms of being most helpful are two things. In February, you can see that money flow accelerated against the backdrop of strong relative strength, and it allowed the index to punch above near-term resistance in January, and then have a nice run where money flow stayed positive, and so did relative strength. And then in a normal and natural rotation, we started to go sideways, not only because of simply digesting those gains, but also because obviously the market neutrality was having a big influence on the sector. But what no one else was seeing, and they all thought it was just a healthy sideways consolidation, is that the institutions were actually net sellers of the bulk of the retail stocks in this index, and that in conjunction with the flattening out of relative strength was a warning sign to us that we just absolutely did not want to be overweight in this sector with those type of internals, and that the odds, while they weren't compelling on a breakdown, they were favoring a breakdown. You back with us, Mark?
Thank you, John. Yeah, I'm back. Now what you're seeing is the retail sector, which is Macy's is your poster child for what's wrong in retail. Amazon is just eating brick and mortar retailers' lunch, unfortunately. The mall is just a shopping cart for Amazon right now in terms of stocks like Macy's and Nordstrom's and Urban Outfitters. So even though consumer discretionary has some interesting names in it, the retail sector is not where you want to be, with some exceptions like Costco and some of the deep discount retailers that are actually doing quite well. But Macy's is a poster child for what Chaikin can do for you. Power Gauge was bearish. The stock was underperforming the market. The institutions have been selling the stock since April. Made a new high at 70. Right before the last earnings report, we had a money flow sell signal. The stock was trading at about 49, and the company really disappointed. And that's part of what's been weighing on the market, by the way, because people are wondering how we could possibly have good earnings in the fourth quarter if the retail sector is so weak. But we'll come through this. But the bottom line is you would have been out of Macy's long before that sell signal. But if you were still stuck in Macy's, you could have used that rally to sell it at 50 ahead of the earnings. The stock dropped all the way to 34. or bought a put option, and we've got a new integrated options play put capability that we're not going to talk about on this webinar that helps you find high probability options trades. So we'll end the sector analysis with the weakest sector that shows no signs of bottoming except for a little bit of a short covering bounce today, which is the energy sector. And the key takeaway here, I believe, is that the relative strength has stayed negative since August of 2014, late August, early September. You had rallies along the way when the price of crude oil rallied in March and April, and then again in September and October, but the relative strength to the market never wavered. And part of what Chaikin can do is to keep you out of trouble, and that means helping you avoid the temptation to bottom fish. And bottom fishing in energy has been a very, very costly exercise, and a lot of the value investors that we talk to have really been submarined by not just the price of crude oil dropping, but by the cutback in capital spending, by the fact that the Saudis refused to turn off their spigot and they're keeping production at high levels. So a lot of things have conspired to create chaos in the energy patch, and that continues. And maybe that'll change in the first quarter, but there's no sign of it yet. So having looked at the macro view, let's see how you can use the Chaikin Power Gauge rating to find winners and losers. So here are the winners and losers in 2015. And these were really the big stocks, the places to be. Avago, Broadcom in the technology sector, Valero, Tesoro in the energy sector, refiners were the only strong section. First Solar, some of the consumer staple stocks. The common theme is the Power Gauge rating found these stocks long before they made new highs, or on the way from new high to new high to new high. On the other hand, the losers of 2015 have a fairly common theme. Except for Wynn Resorts, they're all energy stocks. And the Chaikin Power Gauge rating was consistently bearish, as we'll see, on stocks like Kinder Morgan and Range Resources and Wynn Resorts. These are the stocks that you want to avoid in 2016, not necessarily the same stocks, but stocks with bearish Power Gauge ratings underperforming the market. So how do you find these stocks? Well, I've developed a checklist with 4 things to look at. Power Gauge rating is bullish. This is your classic bull. Tells you what to buy. Stock is outperforming the market with strong Chaikin money flow, and we know that because it's green, not red, and it's big patches of green, what John called persistency of money flow. And then finally, you get a buy signal in Chaikin Analytics. And part of what this webinar is all about is conviction. In order to make money in the stock market, you need conviction. You need a methodology that you believe in, that you understand, that works consistently, not every time, but more often than not. And with consistency comes conviction. Conviction is what brought John Schlitz on board, having used Chaikin Analytics for 6 months. Conviction is what made my wife Sandy a successful investor, having never owned a stock until 3 years ago when she started working at Chaikin Analytics, and seeing the testimonials that were coming from our subscribers. And she's now giving webinars showing people how she actually invests using Chaikin Analytics. And she's outperformed the market. Part of the reason that she can do this is she doesn't overthink it. She looks at these patterns. Power Gauge on the bottom of this 1-year chart of Activision Blizzard, and by the way, the gaming stocks are just hot. Activision Blizzard, NVIDIA, which makes the chips for gaming computers, among other things. And what Sandy looks at, and what our subscribers have learned to look at, is whether or not the relative strength of the stock to the market agrees with the model. Because when the market and the model are in agreement, you get price acceleration to the upside. And look at this persistent money flow all through 2015 on Activision. And can everybody see how these oversold buy signals typically work 2 out of 3 times, were great short-term entry points for swing traders, places to add to a long position. But this last buy signal shows you where conviction comes in. Sandy actually bought the stock on that buy signal. Activision has reported a series of positive earnings surprises. That typically goes hand in hand with a bullish power gauge rating. The last time they reported earnings in October, the stock had a highly volatile day. It spiked down and then back up again and made a new all-time high. But after that spike, it pulled back sharply from the 38 level all the way down to 33. And along the way, it triggered an oversold buy signal. Very simple pattern that I learned from Larry Williams, whose work on accumulation and distribution was an inspiration for me creating Chaikin Money Flow. And more recently, he did some research that showed that an 8-day low in a stock that's in an uptrend is typically a good entry level. And these entries tend to work 2 out of 3 times. They have a time span of about 1 to 2 weeks, 5 to 10 days, whereas our relative strength buy signals tend to persist for 4 to 8 weeks. So this is for shorter term entry points. But a longer term investor can use them in 2016 to get into some of the stocks that are on John's watch list and my watch list. But the point here is that Sandy had the conviction to pull the trigger. And I know from our conversations, our one-on-ones that we've had with some of our clients, that pulling the trigger is one of the biggest problems that investors and traders face. So let me know if that's a problem that you've experienced. If you have, type Y in the question box. Is pulling the trigger, even when you know you've got a good setup, a problem? No, oh yeah. Well, thank you, Michael. Osman, yeah, option trading is tough, and that's why we created these indicators to give you the conviction. Look what happened around that buy signal in Activision. Money flow stayed green. John's going to tell you his special take on that. Typically, when you drop over 10%, in this case 15% in Activision, money flow goes negative. It didn't. That tells you the institutions are not contributing to the decline. They're actually taking advantage of it. And of course, the relative strength and money flow stayed positive. This is the conviction you need to pull the trigger in highly volatile stocks. On the downside, very important in 2016 to know what to avoid. Bearish power gauge rating, underperforming the market, weak Chaikin money flow, and a sell signal. In Chaikin Analytics, we've got 6 pairs of buy and sell alerts. And the poster child here is Kinder Morgan. Now, a lot of the value investors have been buying Kinder Morgan. We were actually at a show, a conference that John Najarian and Option Monster sponsored, and someone came to our booth and asked to see the system. And I actually put up Kinder Morgan as a poster child for what we do well, how we help investors sidestep landmines and avoid these big losers that can blow up and destroy your portfolio. And when I put this chart up, this gentleman said, oh, that's my largest position. And this was in October. The stock was around 28. And I said, you're comfortable riding a stock from 40 down to 28? He said, absolutely. I said, well, he said, I love the dividend. I said, well, what if the company runs into debt service problems, can't pay the interest on their debt and has to cut their dividend? He said, oh, I've researched this. Never happened. And I turned to this gentleman and I said, John, this system is not for you. Because in order to take advantage of a methodology, you have to believe that the market is smarter than you are. The market is certainly smarter than I am. It's smarter than Jim Cramer at times. Because if you're going to outthink the market or think that you're bigger than the market, then Chaikin Analytics is just not going to work for you. But if you're willing to let the market tell you what to do, let the indicators tell you what to do, and the model give you the probabilities, give you that edge that you get when you know what the probable direction of the fundamentals for a company are, you're going to avoid stocks like Kinder Morgan, and in fact, you're going to use rallies, these overbought sell signals on new 8-day highs, to buy put options. We call that
And,
turning landmines into gold mines, or lemons into lemonade. It's one of the ways that you can benefit in a down market. Now, all of this is in the context of an ongoing 7-year bull market. How many of you have been in the market in 2000 and 2008? If you have, please type a big P in the question box for pain, because we all endured enormous pain. That's part of the reason that I came out of retirement to build Chaikin Analytics. Now, I've been in Wall Street for 50 years, so I've experienced 10 bear markets. And I can tell you that these indicators in a bear market will position you on the right side of the market. If you go short, they find short sale candidates. If you buy put options, so you limit your risk, which is a very sensible way to play the short side, you're going to be buying put options on the weakest stocks in the weakest industry groups if and when we head into our next bear market. So they've worked well in bull market, and they'll work even better in a bear market. And they're more important in a bear market, because in a bear market, you don't want to be bottom fishing. They usually last between 9 and 24 months, and they can be extraordinarily painful, as I see from the responses we got. So the third way you're going to prepare for 2016 is to confirm the power gauge rating with Chaikin relative strength and money flow. We call that the dynamic duo. Now, sometimes the dynamic duo is Chaikin relative strength and money flow, and sometimes we refer to it as the power gauge and the relative strength indicator. The big takeaway is, though, that these dynamic duos help you find big winners and losers, with one caveat. Relative strength stands alone as a bullish or bearish indicator. Why? Because the market is bigger than all of us. Poster child for that is Amazon. Power gauge rating on Amazon has not been bullish since we started the company. The reason is that the financial metrics have been very poor, as Amazon has bought market share with inexpensive shipping and the like. But Amazon somehow survives, and there are periods when Amazon is just a momentum giant. And that's when the relative strength on Amazon points you to trading it from the upside. But always be aware that if you're trading a stock with strong performance relative to the market, but the power gauge doesn't support it, meaning that the underlying fundamentals do not rank highly versus the other 3,000 stocks in the Russell, that you're on a high wire without a safety net. So you need good money management and risk management techniques. You need stop losses, because if you stay with a momentum stock too long, there's a price to pay for that.
and
So,
Mark, just to reinforce that, the reason in a stock like that it's so important to have some sort of indicator that's somewhat leading, or at least is, gives you an idea of what the institutions are actually doing rather than saying, is the fact that analysts are notoriously late in changing their opinion, even after a stock has broken down significantly technically. So it's really important with a stock like that to follow some indicators that are going to show you much sooner along the curve whether money is flowing in or out of it.
Well, that's very true. We saw it, John, in La Quinta that we started off the webinar with. We've seen it in Whole Foods. We've seen it in a lot of the cloud computing stocks. But here we're looking at First Solar, which is the real standout in the alternative energy space. Dynamic duo is strong. Chaikin power gauge, the bottom of the chart, has been bullish since late July, but at that point the stock was underperforming the market. Notice it underperformed from mid-May to mid-October. But when relative strength kicked in with the stock at around 50, you had the dynamic duo working for you. And look at the Chaikin money flow. It also showed you that the institutions had gone from sellers to buyers, because Chaikin money flow looks back over 21 days, measures these patterns of accumulation and distribution, And it's an accurate guide as to what the institutions are doing, the big money is doing on the big volume days. But since early October, everything has been in gear. And First Solar was the beneficiary of a tack-on bill to the budget bill that was passed in Congress last week that extended credits for solar panels. They make a highly efficient semiconductor device for solar panels that reduces the cost of solar energy. Later on in the webinar, we're going to see that not all stocks in the solar group are strong, and a lot of them rallied on that news, but you've got to be able to differentiate the good from the bad. So First Solar is an example of the dynamic duo on the upside, and this is a stock that I'm aching to buy on any pullbacks. It's been hard to buy since the stock broke out in October. You've got to have conviction to buy this stock on those dips. And when you get those dips and the money flow stays positive as it has, you're seeing a big tip off, and John's going to get to that in a minute. Now here's the dynamic duo, which in this case is money flow and relative strength on the downside. John, you might want to analyze this chart of Legg Mason.
Well, you know, and there was a very good example with First Solar that maybe we'll backtrack to after I talk about this, but here's a perfect case where the stock pulls back from a high in February and then consolidates near prior support, and from a pure price point of view, everything looks fine. Stock pulls back, it's holding at support, it's held support multiple times, and sure enough, if I could put up a chart from Bloomberg which shows exactly when the analysts reinforce their buy signals, you would see multiple reiterations to buy right down at this 52 level within that first vertical rectangle. But you know, we of course see it differently. Obviously, not only was the relative strength negative, but while the analysts may have been saying reiterate, their clients, the big institutions, were taking that as a sell signal. So, you know, money was definitely coming out in a definitive way, and it was just that's about as clear-cut a warning sign that we get that support level is eventually going to give way.
So this is a very weak chart, and it's an example of stock with a neutral power gauge, but where in this case the dynamic duo is taking money flow and relative strength. Now, I've always said that the key to making money is to avoid losses, and part of avoiding losses is spotting personality changes before they up and bite you. And we define a personality change as a stock that goes from outperforming the market to underperforming the market, or vice versa. So First Solar went from underperforming to outperforming. That was a bullish personality change. So here's two examples of that. Mylan is a stock that's just now undergoing a positive personality change. Back in July, when they were in a merger mania mode, and the markets got scared off by the various deals that were pending, the stock had a negative personality change with a neutral power gauge rating, and it dropped from 65 all the way to 39. But notice how the money's come back into the stock here in the last 2 months. You've got a bullish power gauge rating, and the relative strength indicator is just about to go into the green because this stock is outperforming the market. So probably at the 55.6 level, you're going to get a bullish personality change with money flow positive and a bullish power gauge rating. And you need to spot these changes to know when to get on the train and when to get off the train. Now let's look at a bearish personality change. And John, you included this chart. I'm going to analyze it because I'm going to do my mea culpa, although events have proven the power gauge to have been correct. But you see this big negative money flow that preceded a breakdown in Starwood, and then you got your bearish personality change here at about 78. Now, in my weekly Market Insights newsletter, which comes out on Sunday, I made Starwood my bearish stock of the week back here about 2 months ago, with the stock trading at about 71. They were due to report earnings, and everything pointed to the fact that the earnings report was going to be terrible. And the stock dropped for 2 days all the way down to 66 and change. And then the day that earnings were due out, mysteriously takeover rumors cropped up on Starwood. First, it was the Chinese hotel conglomerate that was going to buy them. And then a couple of days later, Hyatt was going to buy them. And then Marriott was going to buy them. Now, I don't know what was really going on, but Starwood came out with a very bad earnings report. But look what this takeover bid did to the short side. And that's why puts are a very good way to play the short side, because you've limited your risk. The stock rallied from 66 all the way to 82. None of those takeovers have materialized, and look what's happened. The stock traded all the way back down to 65. So the underlying power gauge rating got it right. The fundamentals for the hotel industry, with Airbnb breathing down their neck and competition becoming a big problem, is not good. And the power gauge rating knows that. But this shows you the fickle nature of Wall Street. It's not outside the realm of possibilities that these takeover rumors were planted by aggressive hedge funds or just mysteriously appeared as a bad earnings report was due out. You be the judge. If you followed my recommendation, you lost money on your put, because the recommendation was to buy a put option, not short the stock. But ultimately, after a 2-day spike, this stock has been straight down ever since. So Wall Street's a very, very volatile place. It's not always logical. It's not easy. And that's why you need objective indicators to help you decide which stocks to buy and which stocks to avoid and which stocks to go short. Now this is John's baby. John, you take over, because you've really coined this phrase, and I love it, and our clients love it.
Well, I mean, one of the ways I love to use the system is to look for what I call stealth activity. And that typically happens when the institutions want to get in and out of a stock, in or out of a stock, but they really don't want to affect price. So they tell the institutional traders who are executing the orders to be very nimble, don't push the envelope. If they're sellers and other sellers come in, back off, and vice versa. They basically don't want to impact the stock at all. Nevertheless, the money flow indicator picks that up, because the stock tends over time to close mid-range or below. And while on any given day that's not a major negative, when it happens over time, the money flow indicator picks it up. And I purposely used some very basic trend lines in conjunction with money flow, because it really helps put both money flow and the price action of the chart in perspective. Now, some of you might be, hardcore technicians, and some of you might just be starting to dabble in technical. Either way, the system can, I think, help you tremendously, because, when you have a sideways price action, you really have no way to evaluate it. But with money flow, you do, and in this particular case, Red Hot had, conspicuous distribution. We didn't have negative relative strength yet, and the power gauge was, neutral to positive, so we may have not wanted to be short the stock prior to the breakdown. But that money flow tells us two things. One, the odds are better that it breaks down than breaks out. And two, if it continues negative on the breakdown, then we can have more confidence in trading the breakdown. Okay. Vice versa with the little wedge pattern there. When I'm looking at a chart like that and someone's asking what I think, first thing I do is look down at the indicators, and I see some pretty massive accumulation without too much price movement. Which means they get aggressive during the day, they back off, and then the stock has been closing on balance at the top of the range for the day, because that's the main factor in money flow, is where the stock closes relative to the range, and then of course how much volume is behind that. And bottom line, it suggested that that pattern would be resolved positively, and it was, and that's and that's what we look for, and it's how we put price action in perspective.
Now here's where it becomes interesting, because where that green triangle is, we generated an oversold buy signal, and this is again where conviction is so important, because that's a tough spot to buy the stock. The stock had recently made a new high, money flow was positive, everything was in gear, but are you going to be prepared to pull the trigger? Well, you have to, in order to take advantage of opportunities when they present themselves. And the bottom line here is that Red Hat reported better than expected earnings after the close or before the opening yesterday, and spiked up to a new high. And if you had followed that buy signal, you would have been either out on the first peak or very happy that the stock made a new high. Now here's stealth distribution in the retail sector, and I think this chart speaks for itself, John. We had 3 sell signals in there. Nordstrom was going sideways, power gauge was bearish, money flow was just a disaster. What do you think the institutions were doing in here? I mean, they were persistent sellers, even when the stock was rallying to the upper portion of the range.
And again, the value is not only in suggesting that it would probably break down, but it gives you, most technical traders, if they're conservative, they wait for a breakout or a breakdown. And this gives them it gives them a confidence level that they normally wouldn't have.
Particularly when the power gauge is bearish, because that's telling you the fundamentals are negative for this company. And sure enough, just like Macy's, very negative earnings surprise. Now the institutions started buying it, probably some short covering going on, but the stock broke down to yet another new low today. Even with the market up, it was down 1.75% at about 1 o'clock when I pulled this. Well, John, you did this yesterday, actually, so this chart is from yesterday. But the key here is the weak get weaker and the strong get stronger. So let's look at a current example. Twitter, fallen angel, bearish earnings report back in April. The stock went sideways for over 9 weeks, and the money flow stayed negative, and you got a sell signal right at the end of that consolidation pattern, with the power gauge bearish and relative strength bearish. It actually doesn't get any better than that. Relative strength sell signal, the stock has started to reverse back to the downside after crossing above its 21-day average. Buy a put option. And by all means, don't bottom fish and go against this very powerful set of indicators. The market is agreeing with the model. The money flow is negative. That's your stealth distribution. And Twitter continues to make new lows. Change of management, probably not going to make a difference. Very difficult, by the way, to do business with Twitter. We put ads on Facebook and Twitter and Google. Twitter makes it hard to pay them. You try and put some sort of promotional ad for a webinar on Twitter, and they make you jump through hoops. It's no wonder that the stock is doing poorly. So now you know my checklist for preparing for 2016. Identify strong and weak sectors and industry groups. Use the power gauge to find winners and losers, and confirm the power gauge with Chaikin relative strength and money flow. Now we're going to get into looking forward. How do you find the best stocks of 2016? Well, it's my view, and by the way, this is a chart of the S&P ETF, the SPDR ETF. And the section that's blocked off in yellow is the first quarter of 2015. It's my view that the best stock in the first quarter of 2016, not the full year, but the first quarter, are going to be the stocks that have performed best over the last 6 months of 2015. And in fact, the success of the power gauge rating tells you that. In the period between Thanksgiving of 2014 and the end of the first quarter, the very bullish stocks, and this is an annualized number, in the Russell 3000 were up an average of about 5.6%, and the very bearish stocks were up less than 1%. So the stocks with bullish power gauge ratings that had strong relative strength led the market in the first quarter of 2015. And here's an example of that. Skyworks, which was our favorite stock of 2014, and bless her heart, my wife Sandy owned that all the way up, got out near the highs, and we've taken a couple of vacations on that trade. It was really an investment position. But Skyworks, which had led the market higher all through 2014 into the November 29th Thanksgiving period, was up 55% to its high in the first quarter in March of 2015. On the downside, Pandora, which had all the elements of a classic bear, underperforming the market with a bearish power gauge rating. This chart ends in April of 14, as did Skyworks, by the way. That stock, which had been weak in the final 6 months of 2014, dropped an additional 24% in 2015. So the question is, how do you find these stocks? Well, our new screening capability, which we'll demo live in our real-time portion after the PowerPoint is done, our screener makes it so easy to find these stocks. In this particular screen, I started with the Russell 3000, filtered out illiquid stocks. That got me down to 1,500, and then required that the power gauge be bullish. That brought me down to 318 names. And because I like earnings surprises, I think they tend to repeat over and over again, as we saw with Activision. I required that one of the factors in the 20-factor model be strong. That cut the universe in half. And then I said, I want stocks that are beating the S&P by 20% over the previous 6 months. And that narrowed the universe to 50 stocks. And we'll show you how quick and easy this is to do. I then took our two core technical indicators, money flow and relative strength, and required that they both be strong. And I wanted to see just large cap names, 2 billion or more. Narrowed the universe down to 22 names. Took 3,000 stocks and found what are likely to be the best performers in the first quarter of 2016. We've already seen Activision Blizzard. We're going to see Nike in a little bit. Tesoro, Leidos, which is a defense contractor, NVIDIA, which makes those chips for the gaming industry. It's so easy now with the stock screener to zero in on stocks that meet your criteria. In this case, I was trying to find the strongest stocks leading up to 2016, and I was able to narrow this universe down in a matter of seconds. It took less than a minute to do this screen. So let's look at a couple of those stocks. Tesoro happens to have a neutral rating right now. That doesn't trouble me because it's in that very strong refining group with Valero. And Tesoro is likely to be a leader. The reason is they benefit from the lower cost of crude oil. And the stock was up 1.5% earlier today, actually finished probably stronger than that because energy was a big component of today's upward move. This is a stock that's likely to outperform the market in the first portion of 2016. Remember, these are not recommendations. This is for educational purposes only because we're not registered with any state or federal agency, but these are good examples of stocks that are likely to outperform the market in 2016. Leidos, defense contractor. Look at that money flow. Institutions were accumulating the stock in this basing period. It was underperforming the market. That's that stealth accumulation that John was talking about. And then in late July, money flow turned positive and relative strength to the market turned positive. And finally, the power gauge went positive. So everything's in gear. You just had an oversold buy signal. Defense contractors are trading rather well after the sad terrorist attacks in Paris and San Bernardino. And I think this is a stock that should be on everybody's watch list. It's a potential outperformer for 2016. Now, very briefly, John and I are going to share our watch lists of stocks to be monitoring in 2016. So, John, why don't you kick it off, recognizing that we want to do a little bit of real-time demo, and we put together a pretty long deck here because this is so important.
Okay. Do you want me to start?
Yeah, these are your stocks.
Yeah.
Some of them are in the consumer staples area, so perfectly meshes with our sector analysis.
Gotcha. Okay, well, this is pretty self-evident. We had almost a 2-year consolidation after a very big move up. You can see that relative strength earlier in the year turned positive and stayed that way, and the stock started to make a series of higher lows in the back half of the year, and then finally broke out. Money flow traded to a new 18-month high on the breakout, so it confirms the breakout. Obviously, it's late now. I wouldn't chase it, but this is a stock that will probably go into a 2 to 4 week consolidation pattern, and if I like the way it shapes up, and they usually do shape up constructively when you have a breakout this aggressive, then we'll be looking to buy the stock. Probably.
By the way, John, this is one of the 20 stocks in the First Trust Chaikin Low Beta Growth Portfolio. So the computer screens that we use to help them choose that portfolio found Tyson's Food.
Kroger, given the volatility that may surface in the first quarter because of so many, moving parts, I like it because of the breakout to new highs. I like the way the credentials are turning positive, although it doesn't look that compelling when you look at the long-term chart. But the power gauge, the relative strength, the money flow are all pretty good. Again, these are stocks that if you don't get them right on the breakout and they run, that's okay. You wait till they pull back, and if they pull back constructively, that's where you take a close look at them. So that's definitely on our watch list, and especially being a defensive stock, because we like to have a little representation there, given the fact that money tends to flow towards these stocks when the volatility increases. Cores down and out, nobody wants to own it. Money flows improving a little bit. Stocks oversold. Relative strength again improving, but not positive yet. It's intriguing that the fundamentals overall, measured by the power gauge, are improving enough to have improved enough to turn the power gauge bullish. So this is definitely on my watch list, because if it breaks out of that 4 or 5 month base, it'll also break a multi-year downtrend line. So it looks interesting, and I'm not worried about losing the 6 or 7% I might give up by waiting for the breakout, because if that breaks out, you're going to have a 55, 60 target, so I'm not worried about being more conservative and waiting for the breakout.
And by the way, this is another one of the 20 stocks in the First Trust Low Beta Growth Chaikin Growth Portfolio. So coming at it from two different perspectives, John with his very, very effective analysis using 5-year charts, and me with the computer looking at the factors in the Chaikin Power Gauge rating, coming to the same conclusion. So here's my list of stocks to watch. Nike reported better than expected earnings after the close last night, actually traded higher in the pre-market, and then profit taking set in. And this is a stock that I'd look to be buying on weakness. Nike has all the elements of a consumer discretionary stock that's going to benefit from an increase in consumer confidence and spending, and this is a stock I'd be looking to buy on weakness. Ideal spot would be down around 125.6, but I think this is a stock to watch in 2016. It was strong leading up to Thanksgiving, and typically these stocks do very well in the first quarter. Google, Alphabet, formerly Google, I don't know when we're going to stop saying that, but Alphabet has actually turned into a pretty dynamic stock. A lot of people question why Google rebranded themselves from a company that had worldwide recognition, turned into a verb. Googling obviously is something we all do, just like we used to Xerox in the 60s, we now Google. Well, it turns out that by rebranding themselves as Alphabet, they've shown a spotlight on the fact that they're not just a search engine with ad revenue. They've got YouTube, they've got Android operating system. It now turns out that they own 10% of Uber. And the analysts are starting to get intrigued with Google. You've had 2 straight quarters of positive earnings surprises. If you're not in a position to buy a round lot that costs you $776,000, don't be shy about buying an odd lot. buy 20 shares of Google, buy 10 shares, buy a call option that enables you to control 100 shares of stock for a much lower cash outlay. But the bottom line is that you had a bullish personality change in June when you broke out on positive earnings. You had a big pullback to fill the gap, so that's a great opportunity to buy it. And here again, conviction is the key, because if you don't have conviction in the power gauge and the relative strength, then you're not going to pull the trigger, and we want you to pull the trigger on these opportunities. So here's a stock that I think is going to outperform the market in the first 3 months of 2016. But if you like Google, I think Apple is a stock to be avoided. And why do I say that? Because you've had a bearish personality change. The power gauge will not turn bearish because they generate so much free cash flow. But I listened to Jim Cramer last night, who owns this in his charitable trust, begging them to do something to acquire, and he put out 4 companies that he thought they should acquire, from Harman to Fitbit, anything to get the stock out of the quicksand that it's stuck in, because iPhone sales are going to be trending down, and this is basically dead money. So if you're looking for the best stocks for the first quarter of 2016, in my opinion, Apple is not one of them. We've been consistently saying that for the past 5 months. Use any rallies to lighten up on Apple, sell call options if your cost basis is so low that you can't bear to pay the capital gains taxes, but be mindful that if Hillary Clinton gets elected, the capital gains taxes may go up. So base your decisions based on the power gauge and the technicals, and not the tax situation, because sometimes it's better to pay the taxes and avoid the pain. But the bottom line here is I love Nike and Google going into 2016, but I'm not as favorably inclined toward Apple. And these are 3 very big high cap growth names, but the power gauge and the other technicals help you differentiate. And then one final point about 2016. As volatility picks up, defense matters. Now, what do we mean by playing defense? We mean avoiding stocks like Chipotle that are facing an absolute nightmare of a E. coli epidemic in their restaurants. Don't bottom fish. Don't get seduced by the people who go on CNBC and tell you that the company will survive and it's got a great franchise and they'll get through this. The weak get weaker and the strong get stronger. Just stay away from these stocks. I said earlier when we were talking about First Solar that there are stocks in the solar energy sector, this case Sun Edison, which makes semiconductors for solar panels, that are not bullish in Chaikin. So here's a classic example. The power gauge turned bearish in July. The stock was trading up in the mid to high 20s. The money flow had been negative as the stock made a peak. There's John's negative divergence and stealth distribution, and then the stock broke down, had a bearish personality change. Playing good defense means recognizing these personality changes, getting out, and then turning landmines into gold mines by buying put options when the stock rallies up. And this has been a very profitable strategy in stocks like Sun Edison. We got this testimonial from one of our recent subscribers: keep away from bears. Chaikin has not only been profitable, but perhaps more important, has kept me out of many stocks that I might have otherwise purchased. That's a really critical concept. It's as important to play defense as it is to find the big winners, because that's how you protect your capital, and then when you flip it and buy put options on these weak stocks when they rally, you have the opportunity to make money on the downside. And a classic example of that was Netflix in October of 2014, where this chart ends. Bearish power gauge. Right before earnings, there was an overbought sell signal. We told subscribers to buy put options on Netflix. If you had bought out of the money puts, your profits were astronomical. But someone who was a little saner said, quick $21,500 profit. I decided to add Chaikin Analytics to my resources, and using the upcoming earnings ideas in Chaikin Analytics, Netflix with a bearish rating was due to report, bought 3 put contracts before earnings on 10/15 at $22 and sold them at $93 the day after earnings for a quick $21,500 profit. You can do this as well, and with our new options play module, you'll find the highest probability options trades. So what are your next steps to success? Well, the time is now. 2016 is approaching, and you've got to have a game plan going into 2016. As we said, it's going to be highly volatile. So the first step is to reserve your free personal training sessions and start reading our daily and weekly market insights now. Sign up for personal coaching sessions to learn about the Chaikin Analytics system and what's there that can benefit you. And start applying the Chaikin methodology to your nest egg now. So Chaikin Analytics we refer to as your fast track to financial freedom. And the reason we say that is because the learning curve is so quick. With Joe Bicella and his team onboarding people, they start using the system and profiting within weeks, not months. And Chaikin Analytics now includes our stock screener and our integrated options play module. So Chaikin Analytics is normally $1,950 for an annual subscription, but we've got a year-end special. We're taking $450 off the cost of Chaikin Analytics, reducing the price to only $1,500, and this offer is good through December 31st, but don't procrastinate. Don't wait till December 31st, because if you subscribe today, you can get an onboarding session tomorrow from Joe Bicella, the day before Christmas, or early next week after the Christmas holidays. So go to chaikinanalytics.com/New Year, and you'll see our shopping cart with that $450 discount pre-populated, or email sales@chaikinanalytics.com. Now, we got this testimonial just after we added the screener to Chaikin Analytics. Thanks for making my life easier. I'm writing to tell you how absolutely incredible Chaikin Analytics has become. It started great, but with options and screener additions, I feel it's absolutely the best product on the market. I've recommended your product to all my investing friends. It doesn't get any better than this. So thank you, JD. And for those of you on the webinar who are already Chaikin Analytics subscribers, by all means, recommend Chaikin Analytics to a friend and let them take advantage of this year-end special. Now, what you get with Chaikin Analytics is the ability, as we've seen, to turbocharge your profits on both the long and the short side, and you get $995 in added value. Our Power Suite product, which incorporates Chaikin Market Insights and John's daily morning insights plus research reports and our portfolio health check, normally sells for $495. Options Play, if you went directly to them because we've licensed this module, sells for between $25 and $45 a month. So that's all bundled in with Chaikin. But more importantly, you get these free small group coaching sessions to learn all the features of Chaikin Analytics and the ability twice a month to call in on our subscriber-only open forums and ask questions. Here, John Schlitz, my son Eric Chaikin. Occasionally I'll be on there answering the questions when the markets are very volatile. It's a complete package, and we're dedicated to your success. So one final testimonial. In the first 2 days using Chaikin Analytics, I more than paid for my annual subscription. In my second week, I made over $15,000 on 3 earnings plays. I highly recommend the system to other investors who want to save time and improve returns. I consider it a goldmine of profitable ideas. So this can be a goldmine for you, and if you believe that, this is our gremlin finally coming into play. Go to chaikinanalytics.com/New Year and take advantage of this special offer, $1,500, $450 saving, good through the end of the year, but again, please don't procrastinate because you want to be prepared for 2016. You've got holidays coming up. We can only eat so much food and drink so much good wine. And there's time to learn Chaikin Analytics between now and the end of the year. The earlier you subscribe, the better prepared you'll be for 2016. So with that, I'd like to thank everybody because the majority of you, more than the majority, stayed on for what is a very long webinar. We really wanted to give you everything we had to tell you about 2016 on one webinar. And we're going to hand it back to Joe Bacella, who's going to curate the real-time portion of the webinar and answer some of the questions that have been coming in throughout the webinar.
Excellent. Well, Mark and John, thank you so much for. I was just reading one of the comments that came in recently from one of our subscribers, Bob, and he was saying this really is the best webinar that you've put on. And Bob's been with us for a couple of years now, and I think coming from one of our best subscribers, one of our best references here for our program, I think that really means a lot. So great job so far. Now, like you mentioned, I've been curating, going through the list of questions that have been chatted. And I think since we've been on the webinar for coming close to 2 hours now, I think the best way to summarize the questions we receive is what is the quickest way that we can find more stocks leading into 2016? And I see that you have the screener open. That's exactly where I'm leading this question to go. Why don't you show us the best way to screen for stocks leading into the new year?
Well, I'll do that, but I want to show you how powerful the screener is. Previously, we had hot lists, Chaikin hot lists, and we've been enhancing them since September to find featured bulls and bears and classic bulls and bullish turnarounds. But you can now do this for yourself. So here's the screener, and we've basically got a blank slate here. So I'm starting with the Russell 3000, and my first requirement is that the power gauge be bullish. And when I click on screen, I've reduced the Russell 3000 stocks. And by the way, I've got a liquidity filter in here, and I'm screening out anything less than $20 that trades less than 50,000 shares a day with a market cap of less than $2 million. Now I can turn that off. And by the way, we've just added an optionable filter. So you can require that it only find optionable stocks if you're an options trader. So it excludes everything that's not optionable. But let's say I turn all those filters off and I rescreen, and now we're looking at 500 names. A big list, 600 actually. They're showing the first 600. Well, that's too big. So how do we filter this down further? Well, I'm going to take some of those value metrics that Warren Buffett looks at, free cash flow, and price to sales, and require that they be strong. So this is a value screen, not a growth screen. And now we're down to 157 names. And I like earnings surprise because, as we've seen, there's never just one earnings surprise. So I'm going to require that earnings surprise be strong. And we're down to 70 names, and now I'm going to bring in that market cap. I want a market cap of at least $2 billion because I'm not looking for small cap names just yet. And we're down to 10 names, and there's First Solar and Leidos, which we featured on the webinar. Here's Old Republic, which is an insurance company that pays a nice 3.3% or 4% dividend. That's how easy it is to find stocks that meet your criteria. Now, let's refresh the screen, we'll reset it, and look for some growth names. And let's start with large cap growth. So we've got a whole series of universes now that give you a head start by helping you define stocks in categories. Actually, let's look at small cap growth. Start out with a requirement that the power gauge be bullish. We have filtered 1,173 names down to 192. American Woodmark, which is a stock we've featured, and Sandy has featured on some of her webinars. Casey's General Stores in that deep discount group. And now let's go to the Chaikin indicators, the technicals that we like. Money flow, persistency, strong for the last 3 months. John talked about that. Relative strength song. And see how many names we end up with. So 61 names, that's still quite a number. So let's require that there have been a signal in Chaikin Analytics, any buy signal within the past 5 days. We're going to narrow this down too far. Narrow it down to 26 names. Well, that's not too bad. And now look what you can do. Click on Save List. This is my small cap growth screen and click on View and Watch List. That list is now going to become a permanent part of your user lists. And the program takes you right to our workspace where you can run a portfolio health check and see which of these stocks are in strong or weak industry groups. So the ones that are in weak industry groups down here at the bottom right, I'm not as interested in. What I am interested in is the stocks that are in strong industry groups. But once you've got that list automatically created for you, you can then look for signals in Chaikin Analytics. So Casey's General Stores had an oversold buy signal. And you can see looking back on the chart that this one here was good. This one was a little early as the market was making that W bottom. But having generated this list of, what was that, 22 names, 26 names, you have all the hard work done for you. The list has been created. You can monitor this, looking for those buy signals when they come up. You can loop through the charts and see whether the charts are in fact confirming what the screen is telling you, because you just don't want to depend on a computer screen. And here we see this company called Form Factor, small cap stock with 500 million market cap. Remember, we were looking at small cap growth stocks. Very bullish power gauge rating. Everything but the technicals, because the stock has been going sideways, the technicals are deemed to be weak by the computer, but everything else is bullish. And this looks like a positive technical pattern to me. So sometimes the computer has its own way of analyzing things, but I love that oversold buy signal that came just a few days ago on December 14th at 844, and the stock closed at 903 today, so it's up about 7%. It was up 2 3/8% today. That's how easy it is to find stocks using the screener. And we'll do one more screen because we know there are a lot of people who are dividend oriented. Let's start with the Russell 3000. We'll require that we're not going to look at the power gauge for a moment. I'm going to reset. So power gauge, initially we don't care about. We're looking for yield. So we want a yield of more than 3%. So how many stocks in the Russell have a yield of more than 3%? Well, there's a whole passel of them. So I'm going to apply my liquidity filter and say I don't want any stocks that are under 20, don't trade 50,000 shares a day with a market cap of less than 2 million. And I'm going to click on screen, and that 538 stock universe is down to 195. But if you're looking for yield, one of the ways you can give yourself an edge is to not lose money in the underlying stock. So let's require that the power gauge be bullish. And now we're down to 34 names. These are all stocks that yield at least 3% with a bullish power gauge rating in the Russell with at least a $2 billion market cap. And if you want stocks that are outperforming the market, you can click the relative strength indicator and require that it be strong. And then finally, if you want stocks with positive money flow, you'll narrow that list down further to 9 names. And again, you can save it. You can save the larger list. You can loop through these stocks. So NJR, New Jersey Resources, I remember is a stock that came up in our group listings. You can go in here and just type in the symbol and see that this natural gas distribution utility has been moving up. The yield is 3%. And it was that easy to screen a large list of stocks down to a precious few names that you can then zero in on. We're all about improving your productivity, improving your profitability, saving you time, and giving you the ability to enjoy the fruits of your labor. So are there any specific stocks, Joe, that we can look at for people?
Let's see. Bear with me for a moment. I know there's a question here, or more of a comment from Gary saying that there's a stock split announced for Nike on February 1st, but no specific stock requests actually, which is obviously pretty uncommon. I see we're seeing it. Oh, here they come. As soon as you mention stock request, they come flooding in. One that I didn't notice here is Disney. I see another for Starbucks and another one for Fizz.
Well, let's look at Disney. That's a great stock because the power gauge has been bearish. And logic, this shows you how illogical Wall Street can be. Logic would have said that Star Wars, which is now going to be the biggest movie launch in history, with all the product sales that they're going to make, follow-ons, logically Disney should be up there making new highs at 120, but the reality is that people at the institutional level are more focused on ESPN because ESPN accounts for 40% of Disney's bottom line, and they have lost 7 million ESPN subscribers over the last 5 years. It's cost them $1 billion in revenue cumulatively, and people are concerned that that franchise is going to turn into a cash drain because Disney paid a lot of money for the exclusive rights to sporting events, and there are fewer people subscribing to ESPN. So Wall Street is never logical, and Disney is a stock with a bearish power gauge rating where the driver is really ESPN and not Star Wars. Now, there may come a point in time that Disney bottoms out, but right now this is a stock I'd avoid until something improves. Relative strength is now dipped negative, and the money flow is negative, and a stock that should be going up on good news is not, and that's a negative sign. And now let's look at Starbucks, which has been doing better lately. We got one little bearish tick in here in early November, and since then the stock has started to go sideways. So the power gauge has been bullish since mid-April. Relative strength has been strong the whole way, but here's this tail off in money flow. People are obviously overinvested in Starbucks. There's a concept on Wall Street that when everybody who likes a stock already owns it, there are no more buyers and the sellers take over. Well, you don't see massive selling in Starbucks, but you do see a stock that is underperforming the market, at least in the last couple of weeks, with a neutral power gauge rating. So Starbucks is a stock that I would be looking for only if it gave a relative strength buy signal. And by the way, the last two relative strength buy signals didn't work right away. The one back here in March did, and that a failure of a signal that works 2 out of 3 times to work is often a sign that the stock is reversing trends. So Starbucks is a stock I'd be wary of here. I think there are better places to be in the retail sector, and one of the stocks in the screener was Darden Restaurants when we were looking for dividends, which is DRI, and there's a stock that's rebounded from a very steep decline. The power gauge has just turned bullish, actually pays 3.4% dividend. These are the people who own Olive Garden. Not sure I'd jump on this train just yet. It's got to get through the 64 level. But the point is, Starbucks looks like it's in a sideways mode, and it's not as exciting as it was from April through August when it made its peak. What else can we look at before we wrap up, Joe?
So continuing the conversation of have we found the bottom yet? I see there's a request here for Wynn Resorts.
Well, Wynn is a stock where the power gauge has been your friend for over a year and a half. As you know, it went bearish at around 195. It's a nice little basing phase in there, but the relative strength to the market is still weak. And I'm not seeing any positive money flow. You got money flow coming off the October bottom, the September bottom in the market, but it's not clear yet that the casino business is out of the woods. Wynn is very dependent on Macau and the Chinese consumer. Macau is sort of artificially restricting tourism. Chinese government's encouraging them in that direction. And there's no indication in terms of money flow. Your first indication on Wynn is going to be if you see a big, consistent pickup in money flow. And there's no clear-cut sign of that. Here's a stock which has actually bottomed out not in the casino business, but in the drilling business. Transocean. And when Transocean was in this sort of dynamic phase back in the fall, money flow was picking up, and then money flow rolled over again. Notice the relative strength never went positive. So when the relative strength is negative and the money flow isn't accommodating and the power gauge is bearish as it is with wind, you're really guessing. And our whole rationale for creating Chaikin Analytics was to put probabilities on your side to give you an edge. If you're buying wind now, you're just guessing that the casino business is turning around. And I'd rather trade and invest on the probabilities than guess. So that really sums up what Chaikin Analytics is all about. And Joe, I think that's probably a good point to end the webinar. I want to thank all of our loyal subscribers, wish everybody the best of holidays. And Joe, why don't you take it over and wrap up
All right.
the webinar?
Excellent. Well, Mark and John as well, guys, thank you so much for your time. This was a fantastic preview for 2016. We had the opportunity to go through a variety of stocks. And, the great part about the program is that you were able to find these stocks using Chaikin Analytics. $1,500 for a full year. That's a one-time payment. That is the best rate that we've seen throughout 2015. And it's a great way to get started for 2016. Like Mark mentioned, we want to have you registered and we want to have you attend tomorrow's onboard session right before the holiday starts. We'll go through a full demonstration of Chaikin Analytics. If you're interested in finding the right stock, timing the right stock, your entry or your exit, option strategies. I saw there were some questions that we weren't able to get to regarding option strategies. We can go through all of those programs during our onboard as well as a demonstration for our options play overlay. So we'd love to have you join us. You can see the contact information here, www.chaikinanalytics.com/new year. There is a link that I sent to everybody a few minutes ago that'll take you right to our website. And then, of course, phone number and email to give us a call or send us an email. So it's a pleasure being here with everybody. Have a fantastic evening. We're looking forward to seeing you tomorrow for our onboard session, and we'll see you then. Have a wonderful holiday.